Thanks everyone for listening in. I'm going to get right to it. And clearly the big story in commodities in the second quarter was oil's recovery, but it's important to remind everyone that that was following a rather historic 80% plunge in the price of oil in the first quarter. Other winners were industrial metals, which following the Chinese recovery, and if you remember, China is the first to get the COVID crisis, and they're also the first country to reopen. And moving over to currencies, the Australian dollar got a nice bounce, and that is because they tend to be a commodity-based economy and supply China with a lot of their natural resources. So that makes sense. Moving over to the bonds, there really wasn't much to mention in the second quarter. While high yield and emerging market did have bounces, we note that they're still negative year to date through June 30th. But what is important is that the Federal Reserve has stated that they do not want negative rates, but they do want to keep yields quite low and have stated they want to keep them low through 2020. Last time I checked, the 10-year is trading just over 0.6% in yield. And we note that it's become very difficult to generate any yield in bonds without taking on significant risk, either in duration, credit, emerging market. And I think what this means is that all fixed income managers are going to need to be nimble and creative in credit and selection going forward. Turning to equities, well, it was quite a quarter, and everyone's probably familiar with this wonderful bounce back from the fastest bear ever. And we remind everyone, as we wrote in the commentary, that the stock markets are not the economy. They are very much forward-looking, and thus, before any economic data began to show signs, they predicted the bounce back and did quite well. But it's not a uniform recovery. If you note, you can see that the U.S. mid-cap and U.S. small cap are still decidedly negative for the year and way behind U.S. large cap. And the tech-heavy NASDAQ is the big winner here, was reaching all-time highs before June 30th. And on the international side, it was a much more tepid recovery, as you can see, but there were bright spots. Moving on to the dispersion, again, this has not been an even market recovery at all. It's been far from uniform and with lots of disparity. And it is rather stunning to note that in the 6 months since the beginning of the year, technology has surged 58% higher over the lowest sector, energy. And when you look at the top 4 performers, technologies, that light blue, and then consumer discretionary. Moving on to some historical perspective, you have to go out all the way to 10 years for energy to break even though it's had this incredible recovery, but it just shows you how beaten down that sector was. And then the final slide for me has to do with market cap. The big get bigger and also more expensive. If you look at the FANG plus Microsoft, they now represent more than 25% of the S&P 500's market cap or overall value. And when you look at the market caps and the returns over on the right-hand side, you'll see that the top 10 companies in the S&P 500 returned almost 10%. The top 50 were positive, but the bottom 450 all had negative returns. And so we think it's very important to note that they're also more expensive, but they're earning their stripes. So if you look at whether it's price to earnings, price to sales, price to free cash flow, or price to book, those large companies are more expensive, but they're also doing quite well. So the final point I'll make is that free cash flow of larger companies allows them to weather a storm like COVID much better than smaller companies who are struggling because it's just the size of their cash reserves is much smaller. Thank you.